Picture two traders taking the exact same setup. They enter at the same price, set the same stop loss, and aim for the same target. One walks away with a clean profit. The other panics mid-trade, moves their stop out of fear, and blows up their account. The underlying strategy worked perfectly in both cases. The market offered the exact same conditions. The failure had absolutely nothing to do with charts or indicators, and everything to do with what happened between the second trader's ears. This chart highlights a well-known industry reality. Long-term success is 80% psychology and 20% strategy. Yet most people hear this and immediately go spend 5 years hunting for a slightly better moving average. When you obsess over a single isolated trade, you invite fear into the process, and fear will consistently turn a mathematically proven system into a string of completely avoidable losses. Look closely at that fear. Most people assume traders are terrified of losing money. That's actually a secondary concern. What human beings truly despise is being wrong. Accepting a small financial loss feels like admitting a personal failure. So instead of cutting it, a trader holds on to a deteriorating position, praying the market reverses just to validate their initial prediction. The market itself isn't threatening you. It doesn't generate danger or malice. Your own mind projects that threat onto the price action because you are demanding to know exactly what the market will do next. If you demand certainty from an inherently uncertain environment, you are fighting your own biological survival instincts. You will lose that fight every single time. Mark Douglas recognized this conflict, offering a precise solution based on one core idea. Every single trade is a unique event with a completely unknown outcome. This grid represents 100 trades with a 70% win rate. Variance still occurs. Hitting 5 red losses in a row is mathematically certain. Micro-perspective traders panic at those losses. But zooming out reveals this is entirely normal statistical noise within a profitable series. Shifting your mental horizon from this specific trade to the next 100 trades strips away the shock of a losing streak. You stop expecting every setup to work. Think like a casino. A casino doesn't panic when a tourist dates blackjack. They don't check their pulse over a single hand, because their math relies on thousands of hands over time. The edge protects them. Douglas broke this mindset down into 5 truths. First, anything can happen. Second, you don't need to know what happens next to make money. Third, there is a random distribution between wins and losses for any given edge. Fourth, an edge simply indicates a higher probability of one thing happening over another. And fifth, every moment in the market is entirely unique. Internalize those facts, and the compulsion to predict vanishes. Your only job is to flawlessly execute your statistical edge, again and again. Let's look back at the trader who panicked earlier. If they adopt this macro perspective, their entire reaction changes. When a setup fails, they don't freeze, they just close the position. A losing trade stops being a verdict on your intelligence. It becomes standard overhead. It is simply the expected business cost required to collect your winning trades. Long-term survival in the markets does not require a magical talent for predicting the future. It requires the trained, repetitive skill of following your own rules when the urge to break them is strongest. Accept the uncertainty. Predefine exactly what you are willing to risk before you ever click buy, and you will remove the fear that sabotages most accounts. Let go of the ego's need to be right. Stop gambling and step into that emotionless state of flow where the real money is made.